India is such a large opportunity, large market. There are investors in Delhi, there are investors in Gujarat, there are investors in Calcutta who see that, hey, Bangalore is a great growth story, Pune is a great growth story, Hyderabad is a great growth story. So we felt if we can bring it into a common platform where the platform governs the law so that there's no litigation between people, I think there are enough and more Indians who would love to participate together and buy something like that. If that same investor, if he had the ability to announce it on Facebook and say, hey, you know what, I'm buying this property, who all interested, write to me. People don't do that because when it comes to large investments, they only go to the inner circle of friends. They don't like to broadcast it and talk to everybody about it. But when you go to a party, Neil goes to the same party and says, you know what, I wanted to buy the same, your outer circle of friends, you should have told me, I would have invested with you. Our tipping point in some sense, pandemic, where I'm sure even my investors in my company at that time who had given us seed capital to start a business would have thought that what timing, if we would have invested 3 months later, we would have not invested. Now we've burned $1.5 million which we had raised that time. So a good real estate investment maturity is anywhere between a 8 to 10 year duration. Exiting early is your cashing out early when you have the ability to consistently make that returns for a long time. So the structure is that investors invest in the company owns the property. So effectively the owner is the investor, right? Just via the company structure. So whatever rents which get generated from the company, from the asset to the company pays it in the form of interest to the investors on a month-on-month basis. You can make anywhere between 12 to 13% very conservatively post the fees.
So fractional real estate has been in India for many years already. But what has changed now is the formalization of this space. SEBI has come out with a circular called the SM REITs circular, which allows fractional real estate players to migrate to REIT status and brings in liquidity into this segment. Today I'm sitting with the founder and CEO of the largest player in this segment, Strata. So let's start at the beginning. Tell us a little bit about the evolution of fractional real estate in India and your own journey.
Okay, so it's not something which is new. I think people have been doing it for decades before. Families have got together and bought properties. Friends have got together and bought properties. Just that what Strata was able to establish was just a platform, a more trusted platform or a more common platform where people with common interests are coming and investing together. In the former part of business where friends and family investing, and I'm a lawyer by education, I used to practice for 10 years. Most of the litigations I've seen is predominantly in those area segments where inheritances have happened, the brother wants to sell, the other does not want to sell, somebody wants to lease at X price, the other person does not want to lease at an X price, and all sorts of issues as such. So what we realized in real estate buying in general in the unorganized manner before platforms like ours existed was there were 2 or 3 things which used to happen, right? Let's say Neil came to me with a property, he's my best friend. He says, you know what, let's buy this property in Bangalore, great returns, etc. I'll have 2-3 immediate thoughts. I'm like, hey, Neil is rich. He has the money. Why is he proposing it to me? Definitely there's something catch, or Neil is shortchanging me, making money out of it. So first is trust issues. Second, despite you being my best friend, but when it comes to large sums of money to be invested, there is always this 1% of trust element, or some third person requires to put that seed in my mind for me to think on the same lines. Second is I might not have the liquidity because an opportunity to buy is not going to stay longer. You want to buy something, if it's up for sale, it's usually up in the market for 2 months to about a year. You can't wait for 3 years later for liquidity to arise, and the price should be the same as well because the price also keeps increasing. And the third is I might not see the same vision. Let's say I'm from Pune, I'm from Chennai. You're saying Bangalore is great, let's invest, etc. I don't see the vision in Bangalore. Or I'm in Bangalore, but you're saying let's invest in MG Road. I'm like, MG Road is saturated. I don't want to invest in an MG Road. Like, or BKC in Mumbai, where people say about saturated. There's no more growth you can see in this market as such, right? So these are reasons why a transaction doesn't transpire in a large way. We felt that, okay, if that same investor, if he had the ability to announce it on Facebook and say, hey, you know what, I'm buying this property, who all interested, write to me. People don't do that because when it comes to large investments, they only go to the inner circle of friends. They don't like to broadcast it and talk to everybody about it. But when you go to a party, Neil goes to the same party and says, you know what, I wanted to buy the same, your outer circle of friends, you should have told me, I would have invested with you. whether or not they had the money or not, but they will come and tell you something like this, right? So we said, India is such a large opportunity, large market. There are investors in Delhi, there are investors in Gujarat, there are investors in Calcutta who see that, hey, Bangalore is a great growth story, Pune is a great growth story, Hyderabad is a great growth story. Or, let's say office asset is a great growth story, or warehousing is, or industrial is, whatever, right? So the idea is that opportunities never are available on a platter, or the opportunity size is very big for them to participate or even acquire something like this. So we felt if we can bring it into a common platform where the platform governs the law so that there's no litigation between people, and there are clear rules and regulations around how things will operate, whether leasing, selling, how many people have to take decisions, etc., etc. I think there are enough and more Indians who would love to participate together and buy something like that. So that's where the genesis of Strata and platforms like ours ideally have started.
Right. And now it's been a 4-year journey for you. Tell us how the pandemic impacted you, because that was a big event that took place between your foundation and today.
So we started out effectively by January 2020. We took our first asset at that point of time, built in a small 10-12 member team, and we're trying to build up ground up as such. But we couldn't subscribe to our first asset. It took time because many were like, hey, we don't know who you are. And the whole concept of buying real estate online without seeing an asset was a very large thing, right? People thought we were Ponzi schemes also. We've got all sorts of such kind of messages also. But so that was one of the things. We took our second asset.
How large was the first asset?
It was about 21 crores. We eventually then gave it to one investor of ours who said, I'm ready to buy it. If you can't subscribe it, give it to me. It's a good deal. I'll buy it off. So he bought it. Then we did a second asset.
And was that an office, a warehouse? Or?
It was an office asset, which we had taken in Bangalore, a brigade property at that point of time. Then we took a second property again in Bangalore, again a 24 crore asset. We said, okay, cool. We had 21 crore asset. We had about 12 or 14 crore at that time. So we said we have that set of investors who are keen, who trusted us, who will be ready to participate in something else because whatever reasons we couldn't subscribe. So they came through. Most of them, almost 70-80% came through, and we tried to fund the other asset. This took us almost about 3 weeks to fund 24 crore asset. We funded about 22, 23. So we were short of just about 1-2 crores, and lockdown got announced. So we were scared because it was first asset. We don't know what's happening, work from home, all that. So we decided to call off the asset. So many of our first investors, like, boss, 2 times I failed already. What is happening and stuff like that. And it was April. We were at home doing nothing. In May, we said, okay, we're anyway sitting at home. Let's put a shot. So like refugees, in fact, I had traveled from Chennai to Bangalore to see a warehousing asset, took permissions, cross borders. That time it was literally crossing borders. Came in and saw the asset, and we said, let's do it. It was a warehousing asset at that point of time. And we said, let's go for it. My team was like, are you mad? We couldn't fund a 22 crore asset, 24 crore asset. And we went in for a 54 crore trade. Literally, my team had no confidence. I had some conviction with a simple attitude that we have nothing to lose. We're anyway sitting at home. We might as well try. That paid off because everybody was at home, and stock market crashed and bunch of other things. So people were keen to participate in certain fixed alternative assets. And we had this good long-term lock-in lease with a good tenant. So we said, let's take a punt. I remember we did close to 80, 90 webinars, if I'm not wrong, during that time. Each webinar had 50, 100, 200, whatever number of people who we could reach out to, going after associations, communities, as many possible. And that was a tipping point in some sense, because while we took 45 days to subscribe such a large asset, but we were successful enough to subscribe it fully and do the most effective way possible, because the first 2 assets gave us good learnings for us to ensure that we can not make the same mistakes and do it much faster and more efficiently rather with our back-end processes. Then we did it efficiently and we could acquire the asset as such. So that was our tipping point in some sense, pandemic, where I'm sure even my investors in my company at that time who had given us seed capital to start a business would have thought that what timing, if we had invested 3 months later, we would have not invested. Now we've burned $1.5 million which we had raised that time. But that honestly was our tipping point to where we could scale up, because many investors who thought the concept was new were on the fence, kept tracking us for several years, then invested, let's say 2 years or 3 years or 4 years later, is been the journey for us.
And you've gone from there to today 1800 crores. And how many investors?
So we have today about 3,500 investors on our platform who have made at least one investment to us.
And what is your minimum ticket size?
So it's 25 lakhs. First couple of deals we had kept 10 lakh rupees as well. Then in 2022, we allowed women investors to put 15 lakhs, but for men it's 25 lakhs only. Again, the idea of allowing women to put lower ticket sizes because it's a new asset class for them as well. We also, it was on Women's Day when we thought we'll do it, and we always thought we'll try with one. But to our surprise, it became such a big phenomena that earlier we had 80% of our platform were men, women were 20. When after we did that, we today have close to 45% women and 55% men.
Wow.
Yeah, so that it's not that 15 lakhs was probably the only thing in my view, but at least I believe that was a starting point for people to say, okay, let's explore with a new platform and then I'll probably invest furthermore. So we were very happy from a financial security what we could create for women.
Now let's come to taxes. How are the returns generated and exactly how are they taxed?
So one thing which we have as a thesis and it's in our DNA is to under promise, over deliver, because you promise higher returns, people come with those expectations when they make lower. Still it's very high from industry standards, but people are disappointed. So we target typically anywhere between 12 to 13%. We don't target more, while IRRs, where we are very confident that we'll hit way beyond 14, 15, 16%, but we target anywhere between 12 to 13. The most conservative way to do our business, we follow the same process.
So generally people say that the rental yield on commercial real estate in India is around 8 to 10%. So that additional 3-4% is from price appreciation?
Correct. So 8 to 9% is your average commercial. 10 is a little difficult to get because the seller will not sell to you at such high yields. But 8 to 9 is a good number for you to target for. Especially in this high interest regime, it's there. As the interest slows down, you will probably get anywhere between 7 to 8 then. But yeah, appreciation is anywhere between a 4 to 5%, and conservatively is what you should target to make it. Some assets can give you higher, some can give you lower. Average out 3 to 4% is the most conservative, which you know short you're going to make out of it.
Right. Of course, that appreciation component only comes into play when there is an exit.
Yeah.
So how many exits have you had?
So we've exited one fully as of now, where we had targeted 12.5, we made 15.1% out of that trade, and we're exiting two more right now as we speak. Just before the regulations hit, we want to exit those couple of assets for our investors as well, and there we are targeting anywhere upwards of 16%, 17% in terms of returns. That's the term sheets we've executed with certain couple of assets which we're exiting. So we know what is the value which investors would make out of it.
Right. But as a percentage of your AUM, how much is exited?
So as of today, as a percentage, we've exited 1.5% fully. The two which we will exit will work around close to 15 to 18% of our AUM would be our total exited AUM. So the idea was to churn 20% because most of the early investors who invested in 2020, we felt it's good for them to have a churn. It's also for investor confidence in some way, for them to feel confident that okay, it's not just an entry, there's also an exit out of it. It perhaps might not be the most prudent to exit assets in 3 years, 4 years, because a good real estate investment maturity is anywhere between a 8 to 10 year duration. Exiting early is you're cashing out early when you have the ability to consistently make that returns for a long time. But again, we felt it's a good clause and good time for an investor to take an exit, and also many of them are like, hey, let's just take a churn, because many have invested in second, third, fourth, fifth property with us. So like, okay, one goes live, won't change for me, but that way it will build a lot of confidence for me also that there has been a churn in the portfolio. So our target was that we will churn out 20% of our portfolio in 24. But now that the regulations have come, we're still going ahead. We might be short of a couple of percentages here and there, but 17 to 18% we will churn.
every year?
This year, we will churn. Post the regulations, we want to understand the whole regulatory piece and then decide about it. We are not the decision makers about exiting. We can only advise as an asset manager. Decision again is in the hands of the investor if they want to exit or not exit.
Sudarshan, now let's turn towards the legal structure. How is it that the money is pooled and invested?
We do private limited structures. We don't do LLPs. LLP has its own challenges also at the same time, and few are okay to do it, but predominantly everything in our portfolio is private limited company. So what we do is when investors subscribe to the securities of the company, we issue equity and CCDs to them. CCD stands for compulsory convertible debentures. They come with a coupon rate. So whatever rent which the company is getting, which owns the asset. So the structure is that investors invest in the company owns the property. So effectively the owner is the investor, right? Just via the company structure. So whatever rents which get generated from the company, from the asset to the company pays it in the form of interest to the investors on a month-on-month basis. So that is the current structure which we follow. The rules which we put forth is with respect to sale, we need 75% investor consent that who are attending the EGM for them to that's as per law. Voting. That's as per law again. Depends on the number of shares you own.
As per the Companies Act.
As per the Companies Act, because that's the only act which is governing the structure which we follow. So we follow that structure and we take decisions about exiting. For debt, if there's any 1% debt to be taken, 1 rupee debt also, 100% unanimous approval is required. Otherwise, we do not take debt at any point. The idea is to be a deterrent that tomorrow nobody, even let's say we, don't have the right to take debt without them having knowledge about the entire thing. So our articles are very clear about the company and the agreement which you sign with the investors, that our rights is only once you 100% decide to take debt is when we will take debt, in the event if that has to be taken as such. So these are two major things which are governing. Rest, we have asset management agreements which gives us certain asset management rights to manage the tenant, talk to them, collect rents from them. If they don't pay rents, knock their door, whatever is required to ensure that the rents get collected, etc. So all that is a part of the asset management agreement which we execute to ensure that we have control on the day-to-day affairs. But the most integral parts of the property, let's say something breaks tomorrow, and the expenditure for that is very expensive. So that all that beyond a threshold limit, we come back to investors, take their consent and then go about doing it.
So the returns we spoke of are net post those fees, right? The various asset management fees that you have to collect.
Yes, so you can make anywhere between 12 to 13% very conservatively post the fees.
Right. But how much is the fee typically?
1%.
Right.
Standard 1% of the rents which you generate.
Right. It doesn't vary from property to property.
It doesn't vary.
Right.
I mean, in the initial days when we were building business, earlier it was 0.5%, etc. But it's 1% standard, barring 3 properties, everything is standard 1% for everybody. So people are also aware, okay, what is the expense ratio for all the assets?
Understood. Now, you said that most of the return comes in the form of interest, which is fully taxable at slab rate. So an investor is looking at a post-tax return of, anyone who's in the highest tax slab is looking at 5.5-ish, 6%. So how do you deal with that? As in, then how do you make it competitive?
So, see, investors invest in real estate not for rentals alone. 50% of the distribution is on rentals, but the 50% is betting on the capital appreciation as such. So we take indexation benefit on our investment returns. Let's take an average of 5% basis pegging to inflation for the last 10 years. So 5% is the appreciation you're going to make. So anything you make on appreciation, net, you're not paying any taxes. If you make 6, indexation is 5, you're paying 0.2 on LTCG. So again, marginal tax on appreciation. On the rentals, let's say you're making 9% in rentals and 5% in appreciation, net of 14. So an investor on that 9 is paying 30%, assuming he's in the 30% tax bracket. So about 2.7 goes to him. So we're left with 6.3 plus 5, 11.3 is post-tax, which I feel is not bad for the kind of investment they make.
Right. So now let's talk about how...
Again, this is conservative numbers. We've hit beyond as well, but 11 to 12 post-tax, easy to achieve.
Sure, point taken. Sudarshan, finally, we talk about residential real estate, which is something that is allowed under the SEBI SM REIT regulations. Do you see that area taking off as well?
So a lot of clarity is still required from SEBI. We have a workshop with them soon where we will get clarity on all these aspects, because it's not just us, it's also our investors are concerned with respect to how the migration will be, what is going to be the taxation on this. That's the larger question which investors have post they migrate, because they invested 3-4 years back. If they decide to sell after 2 years, or after, let's say, within 6 months tomorrow once listed, will the indexation and the time of investment will be considered for long-term capital gains, or will it be considered from the time of the REIT regulations or when the units got given to them? So these are certain concerns which is there, but ideally I'm sure SEBI would have thought through a lot of the things, and once we get clarity we will have these answers more clearer, and then we will start migrating into the portfolio for investors to start enjoying the better long-term capital gain from 20 to 10%. So that is also one big kicker which we are excited about.
Yeah.
And then we'll start migrating our portfolio across.
Yeah. So SEBI has brought down the minimum size of a REIT from 500 crores to 50 crores for SM REITs. Would you end up pooling your different projects into a single REIT, or would you have multiple REITs?
We will have multiple schemes. That's the way SEBI has made the structure as well. They give us one REIT license and every property can be a separate scheme. You can have 2, 3, 5 properties, whatever you want. I think it is prudent for investors because they invested in a specific opportunity with specific returns. They would not like something else clubbed with them because they invested for this property, for this location, for whatever it is. So we'll keep that independent and not club two things. Again, there's no merit to club both things as well. There's no demerit as well. So we would try to keep it as secluded with other assets so that investors are only getting that for which they had invested and not being shortchanged by combining assets together.
Yeah. The other thing, so you mentioned the tax, which in case of a REIT is 15% up to 36 months and then 10%, which is capital gains. But the larger component, of course, is currently interest. Can that become dividend or can the nature of that change once you become a REIT?
So to the best of my knowledge, there are two ways in which you can opt in for your regime of the tax structure which you want. One is where you pay tax at the SPV level and distribute the dividends to the investors. Let's say our corporate tax for companies is about 25% plus some surcharge, cess, etc. whatever. Let's assume 27% net over there. So you have a good 73% net which you could distribute to the investors, which is tax free. The other structures you give the way we are currently operating, which is interest structure. So whatever comes, it gets passed through and is taxed at the marginal rate of tax. Now the question is, we have investors who are in the 10% bracket and 20% bracket, and a good majority are in the 30 and above as well, because our ticket size was 25 lakhs and people who have that kind of money are typically in the 30% tax bracket. So question is that what is the most beneficial tax regime is something which we have to opt in for the investors. Prima facie looks like the dividend one is making a lot more sense. So that is the way we will do, again subject to clarity from SEBI around these teething problems or clarifications which we require. I think we'll be very happy to start migrating under those regimes so that it becomes a beneficial tax return. Especially we have a good chunk of investor base which is in the 39% tax bracket. So for them, going through the dividend route is very good.
Yeah.
They save up 2 times the tax which they would have had to end up paying.
Sudarshan, you've had some issues in the past with under construction properties. With the new SEBI SM REIT rules, they don't allow for under construction properties. So that's definitely a positive. For people who still want to take that risk and invest in under construction, or who want land, etc., will they be allowed to continue in a separate structure? How will that work?
So the current regulations is very clear, no under construction allowed if you want to read out, but there's nothing which is stopping a company to continue running their existing business. There's no restrictions again. Clear restrictions that you can't use the same brand name so that people don't get confused that it's the REIT entity only which is doing. So that is a good point what SEBI has thought through and put it in place as well. So yeah, you're allowed to do it. When you do under construction in general, there is always an element of certain delays which can happen here and there because certain things are beyond your control. As well, like let's say in one of the properties which we had invested in, there was a local strike over there which no work could happen for a month, and hence the delivery timelines got shifted by a month. There was a time where we were developing one of our warehousing facilities. It got delayed by 2 months because Tata was setting up a large factory in that area, and they went and bought every cement manufacturing RMC unit and bought out the capacity for almost a year or two. So there's nobody supplying cement and steel to you for that duration as such. You had to get like from far off to do that, which derailed your time, right? So these are certain things which happened. We obviously learned the right way to operate, where we today involve a bank in every way possible if there's any under construction asset. We obviously choice has gone to Kotak today. For 2 of our assets, we've gone to Kotak to ensure that they are there for more corporate governance, financial governance standpoint. RBI gives them all the power to enforce a lot of things against the developer, which we today might not have and stuff like that. So we follow that process so that the timelines can be adhered to. If there's any delay, agreements could be adhered as per the agreements because...
So the bank does the due diligence here?
No, so the bank, what we do in under construction assets is we take certain element of debt from the bank, which we will retire once the asset is completed, so that it's 100% equity and investors get rent. But when they give debt, they have all the powers to take over the entire project, monitor it, and bunch of things. Like there's a concept called as lender independent engineer. So bank will operate and give a lender independent engineer, appoint them, who will monitor the invoices, monitor the construction progress, cost escalations, cost overruns. And if there's anything over and above, then they'll ask the developer to bring that kind of money and will mortgage, take personal guarantee, etc. of the developer as well. So he has, for such small things, there's no merit for him to default because everything then gets reported to SEBI as well. So that's the way we are trying to enforce. And like I said, banks have far more power thanks to RBI. Where they can enforce certain things which you and I might not be able to do it. RERA is still growing as a regulator in the country. Still might take some time before it becomes the enforcement authority in some sense. So until then, rely on RBI's capability to block the developer from defaulting in other aspects as such.
Now let's talk about the kind of assets that you invest in. Are these commercial spaces? We've heard a lot about how post-pandemic office spaces, the demand has been coming down, or is it other kinds of assets? Could you throw some light on that?
So offices haven't really come down. In fact, last year we saw record leasing as well. Yes, the speed at which development was happening, it's kind of muted because earlier developments were very forward commitments where companies were in line wanting to take office spaces as such. I would say it will continue for another year or so. Predominantly, India is very competitive from its pricing with the kind of knowledge capital we sit on. So there's no question why office demand will not be there. Just that office demand is now spread across geographies. It's not only Bangalore or Pune or Hyderabad or Mumbai. People are now talking about Jaipur. People are talking about Ahmedabad. People are talking about Lucknow, Cochin, Indore, etc. Right? So it's getting more scattered in tier 2 markets as well. Large corporates are sizing large office spaces in those markets as well. So that is where you're seeing a thing, and work from home is getting adopted in some sense. It's not fully. Many guys who've been trying, have been assessing the same, have now come back and saying people have misused work from home rather than take advantage and be more efficient in some sense. While efficiency has not dropped, but the misusing has gone up significantly, and hence many companies are trying to come back to office. It's also about building culture. You build a large organization with the culture of the organization. If you only remotely working, you will not have a culture to stand for also. So many companies are realizing that as well, and are also building. Many people have become very anti-social in some sense. So we don't see work from home as a long-term phenomenon. Yes, it is there to stay. There will be certain set of audiences which will always, who have adopted and adapted now to the work from home culture, will continue to operate, and you can't take that out from them because they're just so settled in that ecosystem right now. But otherwise, the demand for office space, the number of GICs who are wanting to enter India is significantly high. I think.
Sorry, what are GICs?
So GICs are global innovation centers or global capacity centers. Earlier, we were only back offices. Today, innovation is happening in our country. New product developments are happening in our country. Products which are going to be launched in 27, 28, 29 for these companies are getting developed in our country today, right? So we are, like I said, knowledge capital. We are not a back office anymore. Back office are moving towards more your Philippines and Vietnam of the countries where they are taking over such kind of jobs. But we are now doing hardcore knowledge work. We're building products as such, which is great, which is what you need. So if it's the same guy in the US or in India, he's pretty much doing the same kind of product development. There's no big difference comparatively because they are also as competent over here to do something like that. So that is happening. Last year we saw one of the highest record number of dollars in FDI which got invested in the record number of sectors. I think it has been historic globally. We've not seen any country getting so many $1 billion in so many sectors. I think we touched $70 billion or $80 billion in about 60-70 sectors overall. I think we'll break this record this year as well because India is very stable, clear trajectory where that convergence of several things together is what China was there probably about a decade, 2 decades back. India is right now in that moment where we are seeing something like that. So hence I don't see office spaces going down. Evolution of office space will happen in a different way. Let's say the way managed offices are coming now. Co-working is different, managed offices are different. Co-working is where you want short term, you come and take some spaces. Managed is, let's say a large company says, I don't want to invest in the infrastructure. I'll sign with an operator who can run the entire show for me. He'll take care of housekeeping, taking care of light toot gaya, ye toot gaya. He'll handle all these smaller issues rather than having an admin team invest heavily in capex. People are moving to an OPEX model and are trying to work with operators. It also gives them the agility that, hey, if I want to now expand from 100 people organization to 1,000 people, I don't have to keep scouting for offices. This same operator has multiple locations across which I can just go and opt in and sign a long-term contract and continue doing. So it's more like the company is signing the contract, just that with a managed operator who will manage the space on their behalf is the arrangement, and the industry is moving to a large way towards this managed operator. Not co-working per se, but more managed operations is a scale. So that's on office. Warehousing, we are under-penetrated in a large way to the capacity. And if we have to compete with the world, especially with our exports, efficient warehousing space is very important for you to do it with best-in-class racking systems and bunch of other things which will allow. We've now built large infrastructure of roads, which is making movement of goods from one place to the other in a record time, which used to take longer time. Every time you save, the amount of things you save, you become more competitive to the world economy when you want to compete with China or any other country for your exports as such, right? I think India lacks a good port, which we're now building. There's a big port which is getting built in Maharashtra, which will also cater to this. So all these things are, again, great situations where warehousing will continue to grow. Likewise, we have invested in industrial facilities and we're continuing to invest in industrial facilities. Again, we are trying to go to the same factory owners and saying, why don't you play the OPEX model rather than the CAPEX model? But there is competition there. Competition is from the government because government give incentives to companies to set up factories where they say, okay, if you invest X amount of money, I'll give you some subsidy, some GST exemption, blah, 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 whatever it is for that matter. So that is one competition where the industry has no option but to invest in that because in a 10-year vision, they make so much money. But that same money they could have invested in R&D, innovation, they could invest in better supply chain, hire better people, branding, marketing, but because of the incentive scheme they do it, and obviously government has its own reasons why they give that incentives and subsidies, but that is another play which we are saying that, okay, even if we can come in and play the opco, propco, be the operator of what your core business and let us be the property owner, is another trade which we foresee. See, we are in the business to make 15 to 18% returns for our investors. And if an industrial company is making 15 to 18%, then it's good for them to continue owning the real estate. But if then the 30-40% gross margin business, then it's meaningless for them to put such large sums of money in a 15-18% when they can make 30-40% gross margin, right? And typically that's the gross margin what a typical industry makes as such. So that is the other trade which we see, which is where we are in. We've now forayed into healthcare. We feel healthcare is a very large opportunity in India. Again, healthcare operators had no option but to invest in their own real estate and build it up. And we see that now that more private equity money is flowing into the healthcare sector, insurance's penetration is very high. So quality healthcare is no longer luxury; it's becoming a necessity, and hence it's not a doctor or a patient problem; it's a real estate problem. And can we bridge that gap and make hospitals go asset light? Is another segment which we foresee. So we're in 4 segments right now. Retail, data center, etc. are great segments which we wish to be in, but want to go deeper into these 4 segments before we get into something like that as such. Because retail is about malls, and running a mall is complex. And is the real skill of a mall. It's not the real estate, it's about operating the mall. How much more footfalls can you drive? Because the real returns for the mall is on the revenue sharing, not on the rentals. Rentals will, revenue share will outbid the rentals you could generate for yourself. So hence that is the aspect. So we don't know how to run a mall yet. We are hiring right people, understanding the trade, and then we will get into the same. Similar with hotels, it's an operator model. So we are trying to understand. We've been studying hotels for almost 1.5-2 years now, and once we build more conviction about the entire asset class, we will dive into certain things as such.
Sudarshan, I think you're part of a vanguard. I think we're at a moment in time when this particular segment particularly will take off in a big way. So thank you so much for taking the time to speak to us.
Pleasure is mine. Thank you so much.